Welcome back to another episode of the Rich Dad StockCast. I'm your host, Denney, and today we're diving into one of the most powerful books in the Rich Dad series, Rich Dad's Guide to Investing, and how its principles apply to real-world investing right now. Now, most people think investing starts with buying stocks, but Robert Kiyosaki makes it clear investing starts with who you are as an investor. It's about mindset, strategy, and understanding how the rich look at money completely differently. And joining me today is Rich Dad expert Andy Tanner. And we're going to break down the core lessons from this book and show you how to apply them to building lasting wealth in today's market. Now, before we jump in, don't forget to grab your free tools and financial educational resources at stockcastbonus.com. We've got resources that pair perfectly with what we're covering here today. So, Andy, let's get into it. Andy, welcome back to the show.
Thanks for having me, Dell. I apologize a little bit for the cold. If I have a little cough once in a while, I hope everyone will excuse that. Got a little bug, but I think we're getting turning the corner a little bit.
There we go. That's good. It's good to turn the corner. Now, before we turn the corner, before we jump into our subject today, I do want to talk about what pairs perfectly with our topic, and that's stockcastbonus.com. Tell us, what do the listeners get when they go there?
Well, first of all, great free stuff, and free means no risk. So there's very, very few investments a person can make without any risk. But if a person gets excited about investing a little time in themselves, it's a great alternative to any scrolling that someone does or any Netflix choosing that they have, looking for the movie or the whatever. It's a great opportunity to learn. Right now, we have a free ebook as a bonus there. And it's a life-changing book. Ask anyone who's read it. And it's really designed to be the first step. So let's say someone has, had an epiphany where like, okay, I want to get serious about building my own blueprint, a map that takes me from where I am now to my dream. How do I, navigate a course to get out of the right race? How do I create that game plan? And that's exactly what you can get at stockcastbonus.com. It is a great free resource for someone to really begin to go deeper in understanding how financial statements work, how to build yours, how to change yours, how to manipulate yours. There's a lot of talk about, how bad the government's debts are and, how bad their financial statement is. There's a lot of talk about certain companies that are, struggling. Well, the only financial statement that really matters in your life is yours. And it doesn't matter where you live. It's who you are. Not what other people are doing. So go to StockCast Bonus, take advantage of that free. If you have not done it yet, then go do it now. Don't waste time. Go do it now, start now, and start moving towards your goals.
There we go. Andy, you're already dropping gems on us already, thinking about, don't worry about everybody else's financial books, worry about your own. I think that's a good way to
100%.
kick us off. Now, let's get to our topic here, and we're talking about Rich Dad's Guide to Investing. And the book opens with a really bold claim that there are three types of investors. There's the not investing, the passive investing, and the sophisticated investing. Can you walk us through that, and why does it matter so much to understand those three types: the not investing, passive investing, and sophisticated investing?
Robert's a master of context. If I were ever to have someone ask me, like, what are the great lessons I learned traveling the world, with Kim Kiyosaki and Robert Kiyosaki for 14 years, that's a long time. And if someone would say, what are the things you learned? I would say among, probably a top 5 nominee would be the importance of context. Whenever he speaks, he sets the context first. Whenever he gives a class, he says, we're going to start a study. He starts with context. And what's interesting is when you think about those 3 levels of investor, he's beginning the discussion with who someone is rather than what to do. And that's a big difference between the advice culture and the education culture. Is the advice culture focuses on telling people what to do. Here's the advice, go do this. But the education culture is who someone becomes. If I were to give advice to my mother and say, go copy me, Mom, go do what I do, she can't do it. That'd be like telling her to play the drums like I play the drums, or for me to play the piano like she plays the piano. I can't do it. So I can't play the piano like my mom does because I've not become a pianist. And she can't play the drums like I do because she hasn't become a drummer. We both read music, but we haven't become that person that can make that music. And so when Robert starts off saying, okay, let's talk about who is who, we're talking about who, we're talking about be, who are you going to become? Are you going to become a non-investor, a passive investor, or a sophisticated investor? And, Kim says this a lot. She doesn't look at investments as being risky. She looks at the person doing the investing. That's really, really, it'd be a big risk to put me, as first chair in an orchestra with the viola or something, right? It would be really a risk to put me, hand me a French horn and put me in there. It's not that the French horn's risky, it's that I don't know how to play it. And that's really about what making music and making money is about. Is, Warren Buffett can do things that other people can't do because of who he is. And he's in that sophisticated level. So I think the first thing a person ought to understand is they go into that book and say, all right, which am I going to be? Who am I going to become? Am I going to be a non-investor, passive investor, or a sophisticated investor?
Now, speaking of being and having the investor mindset, why is financial education the real starting point for investing?
Well, I don't know that that's that hard to understand, Dell. I mean, I have a brother who's a homicide detective. Well, before he was allowed to get his weapon and carry it around and wear a badge, he went to a place called the Police Academy. And so he learned first on the risks, how to deal with pressure in those moments. And he had standard operating procedures of how things were going to be done, the best way. I have a brother-in-law who is a lawyer, and he went to law school. I have another brother-in-law who's a doctor. He went to med school. I have another brother who's a computer programmer. He went to college and learned computer programming. So, when you ask that question, think about how weird that is. Well, why would someone want education before investing? Well, can you do anything well, whether it's going out on a fishing boat or baking a cake or being a kid? Can you do anything well without knowing what you're doing? And so my question back to you, I just volley that back and say, well, why wouldn't education make sense first before trying to invest, right? And to me, it'd be insane for someone to, go to the open heart surgery and I say, hey, now you're ready to do this open heart surgery on me. So what do you think? He says, I thumbed through a few things. I got a few tips on the way over here. My Uber driver gave me a few tips on the way over. I think we'll be okay. Well, let's just go see what happens. You've not become an investor without education.
That's a really good point. I watched a YouTube video, so I'm good to go.
Yeah.
Let's talk about habits. What beliefs, what habits separate rich investors from everyone else?
Well, we have these six rules in Rich Dad Poor Dad, and the first one is the rich don't work for money. So what is a habit? It's something you do without thinking. And a lot of people just get up in the morning, they don't even think to invest. They don't wake up in the morning saying, I'm going to work to learn today, which is, principle number 6. I'm going to work for money. And so that's a habit. I think another habit that's really, really important is the weekly meeting. Robert and Kim had Betty the bookkeeper, and they would meet once a month with Betty the bookkeeper, and they made sure that they always paid themselves first and that they ran it like a business, and that they had a habit of once something got in the asset column, it never leaves, right? It just produces cash flow at that point. It never leaves. Once you get one in there, you don't let it leave. And so those are, habits of the investor, but it starts with that context. And, you go back to those 3 levels of investing. Non-investing people work for money. They don't have an asset column. Passive investing people are in the advice culture. They hire other people to do their investing, and they miss out tremendously on what could have been, not only financially, but personally. They never get to discover how good at investing they could be. And then you have, sophisticated investors where that's what they do. They get up in the morning and that's how they think. They're on the inside of deals. They're like a Kenny McElroy who puts deals together. He's very sophisticated. He can put together the investment. He can assemble it. He's way on the inside. People who take companies public, those are on the inside. Retail investors are on the outside. And you can go as deep as you want to go.
There's from the book, Robert talks about you have to learn before you earn. I find that so true. Can you talk to the importance of learning before you earn, like paper trading, coaching, taking courses? Like, why is that important before risking real capital?
Yeah, one thing I do like about stocks for people is the opportunity to open up, as you mentioned, a paper trade account where you can practice. The problem is, until you get real skin in the game, the emotions aren't there. Learning the temperament isn't there.
Can you define paper trading real quick, just for the average
Sure,
listener? Because we're not using real paper here.
Yeah, every brokerage has what they call a simulated account, virtual account, or paper account. They're all the same. So if you watched Apollo 13 and Gary Sinise is in the simulator in the LEM, simulating the voltage and all that stuff, and he's not in real space, it's a simulator. That's what it is. And when you watch Apollo 13, old Sinise is in there and he jacks that thing up. They kill themselves several times, but they practiced at first and they got that sequence down in the simulator. And then once they got the sequence down in the simulator, now they could do it, in real outer space. So that's what a paper account or a virtual account or simulated account is you go to your brokerage, Schwab or whoever, and you say, hey, I'd like to practice this first before I do the real thing, and so you get to make some mistakes and learn from those mistakes in the simulator. You get to be Gary Sinise before you're Tom Hanks, essentially.
Which is, I think, one of the cool things about it's hard to paper trade real estate, but it's really easy to paper trade stocks in real time. I think that's a really neat thing to do. 100%. Now, speaking of, wealthy, why are the wealthy not afraid of investing, but they fear ignorance?
Well, there's three approaches to risk. Most people, in fact, I was watching a documentary with Kim Kiyosaki yesterday about this. And she said people are afraid to invest because they're afraid of losing money. And that's simple. Simply put, obvious, right? They're scared of losing money. And I guess if a person had never driven a car before, and they don't know how to drive the car, I remember when the first time I pulled out on the road for real, I was a little bit more nervous, a little bit more vigilant than when I drive today. I guess it just has to do with what you do every day. If you take someone like a dentist and he's done, 1,000 root canals, that's not going to get his heart rate up. If you asked me to do a root canal, I'd be mortified. I wouldn't even know where to start. I wouldn't even know anything about how to do it whatsoever. And I'm pretty sure it would not be effective if I tried. So when people that don't understand investing, they look at it like a casino. I'm going to buy this stock and hope something happens. They don't understand things like protected puts. They don't understand position sizing. They don't understand cash flow. They don't understand scaling in and all the different things we can do to manage risk. So I think it's the risk management. There's three types of attitudes you could take in the Starship Enterprise. Dr. McCoy is afraid to take risks, so he's going to be a non-investor, right? Captain Kirk's going to be a dumb investor because he doesn't think he can lose. He's all about taking risk. McCoy is about avoiding risk. Kirk is about taking risk. And Leonard Nimoy, Spock is about managing risk and being smart. And I'd go with Spock as the investor every time. No emotions, go with the numbers, be smart, no heroics. But when things need to be done, do them and weigh the risks. So I think risk management is what takes the fear away of investing. If you understand the fourth pillar of investing, that's our fourth pillar is risk management. On my team, I'll give you an example. I'm the luckiest guy in the world. I have a Series 4 option principal is one of my best friends and also our lead coaching instructor at the Cashflow Academy. And for a number of years, a couple of decades, here's a guy that worked for a Wall Street firm managing the aggregate risk of a trading floor with hundreds of option traders, then this is sophisticated stuff. And he's not managing just he's managing all the stuff these guys are doing for the firm as their option principal. And so I'm the luckiest guy in the world that, I'll meet with him once a week and we'll talk about what we own. We have an account that we have stocks in together. And that level of risk management, I wish people could experience it, because, when I buy something, a stock or put together an option trade or whatever, it doesn't even get my heart rate up, because it's like driving a car. We've done this so long and so many times that we're not afraid at all. That just comes with experience, and that starts with practice.
There we go. All right, well, let's do this. Let's go to break. We've just covered the mindset and framework laid out in Rich Dad's Guide to Investing. Now, let's make it practical. When we come back, Andy and I are going to show you how to take those principles and apply them in the stock market right now. And don't forget to head over to stockcastbonus.com to grab your free investing tools and get on the path to becoming a sophisticated investor. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning, as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad StockCast. I'm here with Andy Tanner, and we're breaking down Rich Dad's Guide to Investing and how to actually use these concepts to build wealth in the stock market. Now, let's talk about building a foundation first. So what should new investors be focusing on before picking stocks?
Well, they ought to decide who they want to become first. Maybe stocks aren't for them. It could be real estate. It could be business. It could be another asset class. So, you start by reading a few books like Rich Dad, Poor Dad, like Rich Dad's Guide to Investing. In that book, that's one of the thicker books that he's written. It started off with Rich Dad, Poor Dad, and then the Cash Flow Quadrant. I think Rich Dad's Guide to Investing it's probably the third book, and it's the largest one. So you dive into that and you see, what your opportunities are. If you're not very good at raising capital, or that's not a skill you want to acquire, then you probably are not going to be a real estate guy, because you'll be using other people's money and raising equity and debt, and that means raising capital. If you like the idea of click and get paid and not talking to people, stocks might be your opportunity. So just kind of start investigating and learning about your stuff. Go buy one, go buy a duplex and see. And people are like, well, how do it's a duplex. Go buy one, go buy a house and see what happens. See if you're good at it. Go buy a couple of shares of stock. That's a little less of a commitment, and start doing stuff, right? Just start doing, and you'll know whether you enjoy something or not by doing it and learning, and make your mistakes, get mentors, and rock and roll. Having a mentor is a big deal. If I were to start and tell my sons, from scratch, whatever they choose to do, make sure you have great mentors and teachers to guide you along the way. Not advisors, teachers. There's a big difference between a mentor and an advisor, and you want a mentor for sure. Much more valuable.
Let's press into that a little bit. What is the difference between an advisor and a mentor?
Well, a lot of advisors they don't do it in their own life. There's a lot of financial advisors I know that began very young. They take a Series 7 or a Series 65 or some minimum competency test. They start managing money, having not really done it themselves to any degree. So mentors are usually people that have done it, that are actively doing it, that have made the mistakes already. I also think that it's kind of like Rich Dad, Poor Dad. I tell the story a lot, is when my wife and I read it, we thought it was a book about assets and liabilities, which it is. You read it, buy the assets, avoid the liabilities. Don't buy the doodads. Put your money in the assets. Okay. But we failed with that. We tried to go out ourselves, and we were going to be real estate tycoons, and we looked at all these houses and failed to buy any of them. And so upon revisiting the book, we said, what did we miss? How come we failed? It seemed pretty easy. Assets, liabilities. Buy the assets, avoid the liabilities. And then my wife kind of made a joke at the cover. She goes, well, look at the cover, Rich Dad, Poor Dad. We have poor dads. We're halfway there. What we were missing was the rich dad. So you could make an argument that the book Rich Dad, Poor Dad is a book on mentorship. You could argue strongly and correctly that it's the story of a man who found a wonderful mentor to guide him, to reprimand him, to, sometimes give him, tough feedback. Rich Dad was a tough old bird, right? And so, that idea of Rich Dad, Poor Dad, well, do you have a rich dad in your life, or rich dads in your life? And so my wife and I, we stopped looking for deals at that point. We started looking for people that could help us as teachers and mentors. An advisor you're not going to learn anything with an advisor. They're going to take over your account as the advisor, and they're going to run it and be a steward of that account, right? They're going to be a custodian, perhaps even. But a mentor, there's a transformation that happens with the mentor. There's a before and after for yourself of what you know and who you become. I've heard that transformation is what is real evidence of education, and advice does not transform you. If I say, should I buy gold? And you say, yeah, I haven't been transformed. But if I say, teach me about gold, and you say, well, it's fungible, and we start learning about it, well, now I have transformed into someone that knows more about precious metals than I did before.
That's excellent. I think about when you said the advice category, it makes me think of the 21-year-old life coach. Anyone could spout out advice.
I have a dear friend who I just love, and he's kind of a marriage and relationship counselor. And he's I don't know if he's been married or not. Maybe he has, maybe he hasn't. But I got to tell you, it's kind of funny. If you've never had kids, it's tough to give advice, about fatherhood if you haven't done it. And so having done it helps as a mentor. If you've actually done it, that does help, right? It does help.
That it does. Well, going back to Rich Dad, Poor Dad and thinking about, mentors, and, I think one of the things that mentors do really well for us, they help us to reveal blind spots, right? And just kind of make us aware of things that we don't know. And for me, Rich Dad, Poor Dad, it had to do with cash flow. I thought that you were rich when you had a bajillion dollars, right? But really, when Robert Kiyosaki broke it down of, financial freedom occurs when your passive income meets or exceeds your expenses. That was mind-blowing to me. Such a simple concept. So my question to you, Andy, is why is cash flow so important?
Well, we talked about this in a previous episode, and it's worth revisiting here, especially with the book Rich Dad's Guide to Investing, is he has the BI triangle. And on the inside, after you get your mission, your leadership, and your team squared away, your foundation is cash flow. And cash flow is your lifeblood. Every financial statement has expenses, which means cash is flowing out. Every single one, whether it's a church, whether it's a nonprofit, whether it's a government or a business or your household, expenses are being paid. It takes money to do things at any level. And so since cash is flowing out, that's the problem of every financial statement, is solving the problem of cash flow. And there's, quadrants that can identify how you choose to address that problem in your life as an employee, as a self-employed person, as an investor, business owner. And so the idea of how you solve the cash flow problem in your life is core. So when you say, why does it begin with cash flow? Well, because cash flow is leaving your financial statement. You have food, clothing, shelter, medicine, communication, energy needs every day. And answering that is a cash flow issue, which is why 401ks are so awful, because they're a net worth solution to a cash flow problem. If you look at pensions, that was a function of cash flow. It never touched the asset column or liability column. You just got a check for the rest of your life, a defined amount, a defined benefit, a defined amount of money that would come to you till you die to help you address your expense problem. The 401k made it a net worth issue. So if you ask someone with a pension, tell me about your retirement, they'll say, well, I get $3,000-4,000 a month. If you ask someone with a 401k, they'll quote their net worth. Well, I got, $89,000 in my 401k or whatever they have. So the idea that the cash flow is the lifeblood of every business. Warren Buffett, in his, I want to say it was probably 2020, maybe that letter, he said operational cash flow, right? Operational earnings is the most important number in the GAAP total, in the generally accepted accounting and principles total, the GAAP, the general accounting principles total. That's it. And so, that cash flow is what keeps the business going. It's the heartbeat. No cash flow, no pulse. There's nothing circulating there. So it is number one for sure.
So taking it to the stock market, I think a lot of people don't realize you can create cash flow in the market. To the general investor, the novice investor, someone that's new investing in the stock market, how is that possible?
Well, if you make a comparison to real estate, let's say I'm in a syndication, and what a syndication is when a group of investors come together to buy a big project, right? Together. And so they've grouped together, and each of them have, may I say, a share of that project. And so when there's income or earnings, when there's net earnings, they divide or distribute or divvy up or deal out or dole out. They divide those earnings amongst the participants, the owners. Well, the same thing happens in stocks. There's no difference whatsoever. You have something called a dividend payout ratio, and they say, what percentage of our earnings are we giving out to our owners? And we distribute that or divide that. They call it a dividend because it's division, right? And so it works the same as real estate. There is no difference there whatsoever. You take earnings and you divvy it up to who owns the stuff. So that would be the first form of cash flow. You take a company like ExxonMobil, who pays 99 cents a quarter, so $4 a year, basically. And I think it's 40 years in a row, probably, they've raised that dividend every year. So while their stock price goes up and down, their dividend has just been steady growing for 3 decades, more than 3 decades. That's the first basic form of cash flow. But we enhance that by using the options market and receiving premiums, which is for another day. But there's all kinds of premiums you can collect to accelerate your cash flow. So, and real estate uses a lever called debt, and stocks use a lever. We can use debt as well, but we prefer to use contracts as levers. And there's tremendous leverage in futures, tremendous leverage in options, but those are instruments for grown-ups. They're not for the kiddies. They're for, you mentioned the sophisticated investor. They're not for the passive investor. They're not for the non-investor. And why not be a sophisticated investor? It is a lie to believe this isn't learnable. I'm a basic guy that was just trying to stay eligible to play ball in school. I wasn't like my kids. My kids are 4.0 students. I was not at all. So if I can figure this stuff out and fool around with it without too much trouble, I'm pretty sure that you can too.
That's great. Now going back to the book, Robert, talks about the investor's role. It's education, it's control, it's confidence. And speaking of being active, why must you be an active learner? And I preface that because, just over the years, I see where a lot of people fail is they get a college degree and their education stops, right? Why do you have to be an active learner?
Well, I would frame that differently. I mean, your question was, why must I do this, or why do I have to do this? And I just don't feel that way about it. I feel it's something I get to do.
Mm.
I don't feel levered into, like, it almost, like, some people do feel that way though. They feel like, do I really have to learn all this? As if learning it was a bad thing. It's kind of like this beautiful Thanksgiving dinner. It's like, do I have to eat this, or do I get to eat this? What is knowledge if not food? What is knowledge if not nutrition for my mind? What is knowledge if not just protein and carbohydrates and fats in the perfect mixture? Financial education is like dessert, man. It's like a steak. So when people say, why must I learn this? We frame it as if it's something that is unpleasant or difficult to do. Feasting upon this. When I was growing up, my father was like the leader of our church, and he was a religion teacher. He taught at a seminary, and he used to feast upon the word of Christ, is what he used to call it. To him, now to me, church was like, I was just like, oh my gosh, this is long and boring, and these speakers are going on, and all these people. For me, church was like, I got to get out here and go out and play. But for him, it was delicious. He feasted, right? And so financial education's a feast. So, why do I have to feast? Well, you don't, but it's sure delicious. And you sit down to this beautiful table, of Rich Dad, Poor Dad, and the cash flow quadrant, and the cash flow game, and the Rich Dad Guide to Investing. I remember when I couldn't wait to buy the cash flow quadrant, and I couldn't wait to buy the Rich Dad Guide to Investing, because I knew there was food in there. There was nutrition in there. So the question, why must a person do this? Well, they don't have to do anything. If a person's not doing it now, they can continue to live how they're living if they like that lifestyle. But what I see it as is, people get to do this if they want to. They can go to StockCast Bonus right now for free, and they can feast. And there is a meal there that is so delicious and so satisfying and so financially nutritious that you get a feast on this stuff. So I think that school ruins this for us, because school, we're force fed, and we're getting fed things that maybe don't taste good. We're getting fed things that are not nutritious in school. We're getting fed dissecting a frog, which doesn't really do anything for me unless I'm going to be a herpetologist. It doesn't do much for me, but financial education is delicious. So why must a person learn first? Well, they don't have to. They don't have to, but they get to if they want to. And that's kind of that context and that mindset that I think the Rich Dad culture brings. Is this is exciting, and it's fun to study, and it's fun to learn. I love it.
That's awesome. Andy, you started us off by dropping some gems. You've ended us with dropping some gems there. That was a huge context shift. I really appreciate it, because it made me think about going to the gym. I used to say, I have to go to the gym. Now I'm grateful because I get to go to the gym.
That's why you have the arms you have, and I have the arms I have. So.
Well, hey.
You're like my wife. My wife can't wait. She's a psycho person, and it's really what you want. Right? If there are certain people that just love the gym and love the process, they can't wait to get to go. They love it. Other people hate it. Well, some people love financial education. Some people hate it, and to each their own.
That's exactly it. Well, that wraps up for today's episode of Rich Dad StockCast. If you got one thing from today's show, let it be this. You don't become a great investor by luck. You become one by design. The lessons inside Rich Dad's Guide to Investing are timeless and even more relevant in today's economy. And a huge thank you to Andy Tanner for walking us through it. If you want to go deeper, start by grabbing your free resources at stockcastbonus.com. Whether you're brand new or ready to step into the sophisticated investor category like we talked about, we've got tools that can help you. And as always, if you got value from this episode, like, subscribe, share it with someone who's ready to take control of their financial future. Thanks for listening to Rich Dad StockCast. I'm Denney. Stay smart, stay invested, and take control of your financial future.
This podcast is a presentation of Rich Dad Media Network.